Gold prices are sitting at historic highs, yet physical supply is quietly tightening in the world's largest gold buying market. At the same time, pressure is building inside a $2 trillion credit system. Pressure that could help trigger the next major shift in global markets. What's unfolding right now isn't obvious to most investors, but large institutional players appear to be paying close attention. Before we examine everything step by step, be sure to subscribe to the channel and hit the like button so you don't miss important market signals and in-depth financial analysis like this. Gold is currently trading around $5,098 in Western spot markets. China has just reopened after the Lunar New Year holiday, and early reports coming out of China reveal an unusual development. Several gold retailers have stopped offering gold bars for sale entirely. Rather than delaying orders already placed, many sellers are refunding customers in full. When dealers choose to return cash instead of sourcing metal, it usually points to one clear issue: an actual shortage of physical supply. This is not speculation or analyst opinion. It reflects immediate delivery problems occurring within the world's largest gold-consuming nation. The broader backdrop makes this even more significant. Gold had already reached $5,098, while China, a key driver of global demand, was mostly absent during the holiday period. Conventional market expectations suggested that reduced Chinese participation would weaken prices. Instead, gold held firm and even moved higher despite a Supreme Court tariff ruling, ongoing policy uncertainty, and a temporary recovery in the US dollar without breaking down. Now that China has returned to active trading, retailers are struggling to obtain enough physical metal for customers. Observers closely following demand patterns had already considered this outcome possible. Silver is sending an equally meaningful signal, though for different reasons. Managed money long positions in COMEX silver futures, typically controlled by momentum-focused speculative funds, have dropped to their lowest levels in 20 years, even below those seen during the 2008 financial crisis. At the same time, silver has climbed roughly 16% from recent weekly lows, yet speculative capital has largely stayed on the sidelines. For seasoned market watchers, that absence itself carries meaning. When momentum funds eventually re-enter a market starting from two-decade low positioning, earlier price gains can end up looking small by comparison. Both metals appear connected to a broader structural transition. The US dollar's share of global foreign exchange reserves has declined to 56.9%, its lowest level in 32 years, down from a peak near 72%. Central banks are not reducing dollar exposure because of short-term headlines. The shift reflects deeper concerns tied to long-term US debt expansion, persistent fiscal deficits, and a gradual weakening of financial confidence. Meanwhile, combined investor and central bank gold demand has averaged about 610 tons per quarter over the last 2 quarters, roughly 230 tons above the historical level typically associated with about 3% quarterly price appreciation. The reason gold trades at current levels is therefore relatively simple. Documented demand continues to exceed historical thresholds, while physical supply struggles to keep up. Now consider a development many market participants have not yet fully connected. A $2 trillion private credit market has quietly funded much of the global artificial intelligence infrastructure boom, including data centers, computing power, and the physical systems, supporting AI growth. One major lender in this space, managing approximately $273 billion in assets, recently restricted withdrawals from a $14 billion retail investment fund. Whenever withdrawals are limited, markets immediately question liquidity, specifically whether financial obligations could be met under stress. Companies borrowing through the system often carry heavy debt while constructing infrastructure that may require years before generating meaningful revenue. If AI-related earnings growth falls short of expectations, pressure may not remain limited to technology stocks. It could spread directly into credit markets. And private credit is not a small niche. Roughly $2 trillion in pension and insurance capital is tied to these relatively illiquid investments. At the same time, the U.S. pending home sales index has dropped to a record low, falling more than 43% from its peak, while contract closings declined over 8% in a single month. The housing market has effectively stalled. Credit markets are beginning to show early signs of stress. Gold volatility has risen to its highest level since the global financial crisis, suggesting markets are starting to price in risks that have not fully materialized, but are becoming increasingly visible in underlying data. Economist Robert Shiller explained in Irrational Exuberance that markets often reprice risk assets before the broader public recognizes that conditions have shifted. That process appears to be unfolding now in gold and silver, even as mainstream commentary focuses primarily on tariff-related headlines. It is also worth addressing a recurring topic raised by viewers, the role of technical analysis. Some investors argue that technical analysis is unnecessary, and for long-term investors there is some truth to that view. Long investment horizons can absorb short-term volatility, allowing fundamentals to guide strategy. However, large institutional investors still rely heavily on advanced technical systems, not because fundamentals lack importance, but because timing matters. Being correct about direction is not the same as being positioned correctly at the right moment. For shorter-term traders, ignoring technical analysis creates a clear disadvantage. In many ways, it is like navigating blind. The most effective approach combines both perspectives. Fundamentals explain why markets move. Technical analysis helps determine when to act. When structural economic forces align with supportive chart structures, conviction strengthens. Decisions become clearer because multiple analytical frameworks point in the same direction. Developing that skill takes time, but steady learning over 6 to 12 months can lead to meaningful improvement. One often overlooked aspect of technical analysis connects directly to recent silver price behavior. Markets have memory. Patterns tend to repeat. Not randomly, but during specific sessions, trading days, and phases of broader cycles. Whether attributed to algorithmic trading, institutional positioning, or systematic market structure, these repetitions become visible and actionable once recognized. Traders who identified bullish swing failure patterns near $72 or spotted an inverse head and shoulders formation before confirmation were reacting to price structure itself, rather than headlines. At that moment, chart behavior told a different story than prevailing market commentary. The objective is not to create followers, but independent thinkers capable of analyzing markets directly, interpreting primary data, and forming confident conclusions. At the same time, a balanced perspective requires acknowledging potential risks. Gold trading near $5,000 to $98 alongside crisis-level volatility means sharp pullbacks can occur even if long-term fundamentals remain unchanged. High volatility environments produce rapid moves in both directions. Silver's recent 16% rally also leaves many short-term traders sitting on profits, making the market vulnerable to selling pressure triggered by negative news. Additionally, although early stress signals are emerging in private credit markets, no major bankruptcy event has yet occurred. Until such an event appears, institutional capital may continue favoring risk assets over precious metals. Investor Jim Rogers noted in Hot Commodities that commodity bull markets frequently experience sharp corrections that shake out impatient participants, while the long-term trend remains intact. A sudden decline in silver followed by a monthly green close, meaning the month still ended higher, illustrates this dynamic well. Market structure stayed strong even as investor confidence temporarily weakened. This discussion is intended for education, not investment advice. Every financial decision remains an individual responsibility. One data point, however, stands out as gold has outperformed the S&P 500 across every major time horizon. 1 year, 5 years, 10 years, and even 25 years, despite receiving relatively limited attention from mainstream financial advisory channels. This may reflect a structural conflict of interest that delays institutional allocation, often leading to rapid repricing once capital flows eventually shift. Silver mining equities currently trade about 14% below their all-time highs, while spot silver remains roughly 44% below its nominal peak. This divergence, where equities appear to anticipate higher future metal prices ahead of spot markets, is closely monitored in intermarket analysis. In addition, the silver market has recorded 10 consecutive green monthly candles, establishing a historical record. Consider what that implies. Despite a decline from $120 to much lower levels, silver still closed the month higher. That outcome suggests strong underlying physical demand, supporting prices even during aggressive selling pressure. Taken together, several developments are aligning. China's post-holiday gold shortage represents a real delivery failure reflected through refunded orders. The US dollar's share of global reserves has fallen to a 32-year low as central banks reduce exposure. Silver speculative positioning sits at a 20-year low despite strong price performance. And a $2 trillion private credit market is showing early liquidity stress while U.S. housing activity reaches historic lows. These are not isolated events. They appear to reflect the same underlying shift emerging across multiple asset classes at once. Invest with logic, not hype. If you found this analysis helpful, subscribe to the channel and hit the like button so you don't miss future market breakdowns. And share your view in the comments. Are gold and silver signaling a larger financial transition ahead, or is the market simply overreacting?